Realty Income is a very popular REIT in the dividend community, and it does currently offer a yield of over 6%. However, when you do look at the past performance over the last 10 years, it is only up around 24%. And in today's episode, we are looking at 4 REITs that we do like better in terms of the outlook for the future and that have historically performed better. We're going to take a look at each one of these REITs. We'll look at their historical performance. We'll look at their dividend safety, as well as running into a lot of important metrics like their adjusted funds from operation. And each one we are going to run into the valuation model, giving our own assessment of the intrinsic value, our own acceptable buy price, giving our investor margin of safety, and also discuss what upside Wall Street are looking for the next 12 months, as well as the implied percentage upside. So the first REIT that we are looking, in fact, Prologis, it is one of the largest REITs in the world. We do get a double buy rating, seeking alpha as well as Wall Street, although a hold from quant. It also trades towards its 52-week low. It does have a forward yield of 3.67% and a P to FFO of 19.3. Now, similar to Realty Income as well as others in the REIT industry over the last year, they have been hammered due to those increases to the interest. And what we do see over the last year, down 13%, but over the last 10 years, it hasn't been a very bad performer. It is up 152%. If you were to reinvest those dividends, you would be up slightly higher. And we do know all-time highs around 2 years ago, sitting around the $170 mark. Now, in terms of dividend safety, it does sit at 61. It does look to be safe. Market cap just under 100 billion. It is a large cap company, and we do note that the dividend safety was reaffirmed just a few weeks ago. Now, what this means, a dividend cut does look to be unlikely. Now, in the last recession, unfortunately, they did cut the dividend during the 07-09 crash. They had negative 80%, so this was below the average of the S&P, around negative 12, and they also trailed the S&P negative 84%, as we can see the S&P itself negative 55. Now, dividend growth, very nice to note. This year, double-digit increases at 10%. Over the last 5 years, 13%. However, due to that cut in the recession over the last 20 years, it is at a 0 on average, and we can clearly see here the dividend cuts from 2008 and onwards. So in terms of the number of years that they've increased, this 10 years, whilst also paying a dividend for the last 12 without a reduction. Now, very important, we do take a look at dividend yield theory. A quick note for those that are new to the channel: it states a company is undervalued when the current yield sits above the 5-year average. One signal of undervaluation here, another signal with the forward P to FFO below the 5-year rolling of 28.8. And when we do take a look though at the real estate sector at 13.9, Prologis does sit higher, although you could argue it is justified, and we'll take a look at those metrics now. Just remember though, we don't look at any one of those models above in isolation, and we will conclude towards the end. As always, we do focus on the free cash flow. However, for REITs, very special as they are a lot more volatile, so we do draw your attention to the adjusted FFO, funds from operation payout. Now, below 75% is the preference if we want to be specific for industrials. What we can see over the longer term, it has been below that. 2023 at 70% does look healthy, although we do note there is anticipated to increase to 86% next year, something just to keep an eye on, as we do ideally want to see a maximum of 75%. Adjusted funds from operations, well, this is important as we do want to see increases over the longer term, consistent at that as well. Now, we do see 2022 to 23, it did drop, and we are anticipating another drop into 2024, just something to be aware of. And when we do look at it percentage-wise, we can in fact see over the longer term very strong growth, double digits. However, on a trailing 12-month basis, this has slowed down to around 3%, and over the next 12 months, anticipated negative growth. In terms of sales, well, a lot better than the 5 to 10% that we do want to see year on year for REITs. In fact, strong double digit over the last 2 years, and on a trailing 12-month basis, 25% looking very healthy for the real estate investment trust Prologis. Numerically speaking, they have more than quadrupled their top line over 4 times over the last 10 years. And one thing we do want to point out with companies, particular REITs, we do like to see share buybacks, reducing those share counts, returning the excess cash to investors. However, very typical with REITs, they will dilute your position, and it is one way for them to grow over the longer term. Some do this at a quicker rate than others. Realty Income, if you've seen our reviews before, they do this at a very rapid rate. Main reason for this, for REITs, they don't retain a lot of that internally generated cash flow, as the majority of that is paid out as dividends. In terms of the ROIC, return on invested capital, you'll hear me bang on about how important this is when analyzing companies. 10% or more to give us faith management are able to effectively allocate their capital. For REITs, 3 to 5% is the target. We do lower it, and we can see it has improved over the longer term. 4% looking nice right in the middle of that 3 to 5% in 2023. Now, in terms of margins, also nice to know the operating margin has been increasing over the longer term. A nice sense of operational efficiency, going from 24% in 2014 to 41% in the more recent year. Now, in terms of the net debt to EBITDA, very important. This does essentially correlate to both balance sheet strength, dividend safety. This is the earnings before interest, tax, depreciation, amortization. And for industrials, we do ideally want to see below 5. And remember, these are the number of years it would take the company to pay off all of that debt net of cash on hand. Historically, it's been above that, but we do notice a decreasing trend. 5.23 in 2023, anticipated to go below 5 to 4.87 in 2024. So that does give us comfort in this REIT and be able to produce very nice dividend increases like they have done over the more recent period. Now let's jump into the valuation of PLD. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you can be continually notified of these videos as they drop. Now, typically on the channel, we do run through every single one of these models. Today's episode, we're going to do a quick roundup and get straight to it. So today, the intrinsic value of Prologis around $125, the average of the two models that you do see on screen. With the current price at just under $105, we do use a margin of safety of 10%. Now, remember, we only execute on this if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that for PLD, will it buy up to 112? Then we keep going to this near the current trading price, and we can see in today's episode a 15% MOS level. Now, different investors will have different levels before they do want to execute on companies, but in today's episode, a 15%. With Wall Street, over the next 12 months, they see some very strong upside. They anticipate rate cuts to happen towards the end of the year, 30% as we can see, with a price target of $136. As always though, do let us know your thoughts in the comments below as we do run across these 3 REITs again. Now, before we jump into the next REIT, just to let you know, we've released our latest free weekly article. If you want to gain access to this or any others, all completely free, click on that pinned comment below. You get instant access. For example, if you want to read 20 undervalued stocks to consider for the portfolio, or how to find undervalued stocks, where we run through all the resources and websites we use to identify these companies we talk about on these episodes. So the next REIT we're talking about, one we have talked about quite a lot, very nice, Rexford Industrial Realty, REXR, a double buy rating with a hold from Quant. Another one like Prologis, right there at their 52-week low, a yield on a trailing 12-month basis of 3.57% and a P to FFO of 18.51. Now, it is down around 18% over the last 12 months, but if you've been a shareholder over the longer term, you would be up 212%, and we can see all-time highs around $81 around 2 years ago, currently trading around half that in today's market. Now, dividend safety score, very safe, looking very good at 81. Market cap then just under 10 billion. It is a mid-cap company, and we can see here that it was just reaffirmed not too long ago that a dividend cut does look to be highly unlikely. Now, when we move on to dividend growth, this is one that you do need to consider. Look at that, 10% or just under this February, 19% over the last 5 years, and over the last 10 years, strong double digit at 22%, with 10 years of increasing those dividends. Now, in terms of dividend yield theory, we do get a strong double undervaluation signal, a very high yield at 3.82 in comparison to their 5-year 1.91 average, and a low forward P to AFFO, 22 versus the 39 that they have on average over the last 5 years. We do, however, note the real estate does sit much lower at 13.9. Now, in terms of the payout ratio, for the majority of the REITs, we do want a 90% level, and they've been below that again, as we can see every single year. 88% in the more recent year, 85% anticipated into 2024, so it is looking good. We can start to understand why that essential dividend safety does look very safe. In terms of the adjusted funds from operation, pretty much every year consistent increases, again expected to continue into 2024, and when we take a look at it on a percentage wise, it does look very healthy, pretty much double digit for the majority of the last 10 years, 10% anticipated into the next year. And in terms of their top line growth, again very strong, very healthy. Last 3 years years, very nice to note. On a trailing 12 month, also looking good into 2024 at 22%. And numerically, we can see some very strong growth, more than 10 times over the last 10 years. But again, similar to the likes of Realty Income, they will dilute your position at a very rapid rate, as we can see. But if they continue to increase the share price at a very nice return, then again, this isn't something that may be too relevant, but something to consider in your own investment thesis, as well as your margin of safety that we'll cover shortly. Now, ROIC, pretty low from 2014 to 2015, but since then it has been moving in the right direction. 3% in 2023, really the lowest that we want to see, and hopefully it does continue to increase over the next few years. Operating margin, very nice to note, some strong operational efficiency over the last 10 years as well. Always try and look at companies that increase both their top line revenue as well as their margins as well. Net debt to EBITDA then below 5.5, and we can see it has been pretty much mixed year on year, some inconsistency, although from 2018 it's been below that. 2024 expected to be a little increase from 2023 to 4.35, but it is below 5.5. Again, with the payout ratio looking healthy as well, we can understand why essentially this company's dividend looks to be safe, and it's nice to note they have been increasing those dividends at a very strong rate. Now, also don't forget you can click on the pinned comment below where you can grab a copy of this valuation model, getting to your own intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list. Now, a 10% margin of safety indicates a buy up to $53, at 15% around $49.91, and we can see in today's episode it is looking very strong. REXR with a 25% MOS level, and when we take a look at Wall Street, well, they see around 24% upside. Their price target is $54 in 12 months time, so a very strong contender for one to at least do some due diligence on. 25% MOS level with 24% to the upside over the next 12 months. We then move on to a REIT with a triple buy rating. It is Agree Realty Corporation. It is trading to the mid to lower end of the 52-week range. We do see a forward yield of just over 5% with a forward, or in fact a P to FFO of just under 15. Over the last year, down negative 9%. Over the last 10 years, however, it is up around 92%. When we take a look at the dividend safety, a score of 70, so it is safe. Market cap just under $6 billion, another mid-cap company. And again, we can see it was reaffirmed a few weeks ago that a dividend cut is unlikely. Now, last recession, we do know, very similar to Prologis, a dividend cut during that recession, negative 14%, roughly around average growth, but they did trail the S&P with their negative 67%. A little bit on the lower end of their increases to their dividend, 1.2% last month, 6%, so quite nice to see over the last 5 years, but over the last 20, it has been lagging slightly at 2%. Remember, on this channel, we do advocate a minimum of 4% just to keep up in line with inflation. We also note 11 years of consecutive increases with 12 years of paying a dividend without a reduction. Now, we also get a double undervaluation signal, 5.06 currently, and the 5-year looking very high at 19 in comparison to the current at 14.3, and it is only marginally higher than real estate as well, so another good sign. In terms of the payout ratio, well, nice to note, not only below 90%, but it does look to be decreasing over the longer term. 74% in 2023, 72% anticipated in 2024 as well, so no worries so far. We also see increasing adjusted funds from operations year on year, expected again to continue into 2024, and when we look at it on a percentage format as well, we do see some attractive numbers. 3% in 2023, ideally a lower end of what we want to see, and it is expected to be maintained in 2024. In terms of the top line growth, again, with the similar companies that we have looked on this channel, strong double digits, especially over the last few years. 22% on a trailing 12-month basis, and as we can see here, pretty much 10 times their top line over the last 10 years. But again, as we say, very, very typical. They do dilute your position at a very rapid rate. We then take a look at the ROIC. It does look to be moving in the wrong direction. Ideally, we want to see it go up that way from 3 to 5%. But a positive note, trailing 12 months at 4%. So hopefully they can continue to increase this to the upper levels of 5% that we do like to see. Now, margins does look healthy, but we also know that it has been decreasing over the longer term. Again, trailing 12 months does show 49%. So hopefully we can see their top line continue to increase. We'll also see their operating margins move from the decreasing trend to the upwards trend we want to see. In terms of the net debt to EBITDA, well, below 5.5 now. It's been pretty much that over the last few years. 2024 anticipated to come down, so a very good sign for REITs when they are lowering down those debt levels. So that in conjunction essentially with the FFO payout ratio looks to me that the dividend does look to be safe. Balance sheet also looks to be healthy. So in terms of the valuation model, the intrinsic value in today's episode is coming to around $66, and we can in fact see a margin of safety of 10% does indicate it is pretty much around that price. Don't forget as well, this is a monthly dividend paying company, so this could make it attractive to those people who do like to use dividends in terms of their expenses on a day-to-day or month-to-month basis. In terms of Wall Street, well, they do anticipate around 14% of upside over the next 12 months, as we can see that price target of $67, and I know also this is a very popular one in the community, so let me know as always if you have been buying this, or maybe this is one of your larger REIT positions. Another strong REIT that we have discussed before on the channel, it is Equinix. Now this is one where we have a double buy rating, a hold from quant. It is trading towards the mid to lower end of the 52-week range with a lower forward yield than the other ones we have covered at 2.2% and with a P to FFO of around 31.21. Now unlike the other three, a very strong last 12 months, up 13%, whilst other REITs have been hammered, and over the last 10 years up 317%, very strong, and also outperformed the likes of Realty Income over the same period. We also note all-time highs around $915. So in terms of dividend safety, well, another very safe score at 86, market cap 73 billion, a large cap company, and we can see pretty much reaffirmed last week that a dividend cut is highly unlikely for this real estate investment trust. Last recession, well, plus 25% sales, but pretty much a near S&P return at negative 56, and a very strong increase to their dividend, 25% in October, 10% on average over the last 5 years, and they have been increasing those dividends for the last 8 years consecutively. Now, in terms of dividend yield theory, we do get that double undervaluation signal, 2.22 versus the 5-year average, but I would be keen to hear as investors whether there are any companies that you don't invest in, as you are having a minimum yield before you look to add companies in your own portfolio. Forward P to FFO 21.6, again lower than the 5-year, so we do have a double undervaluation signal. But like the majority of companies today, this also trades higher than the real estate sector of 13.9. Adjusted funds from operation, well, not only below 90%, but very low, below 50% over the longer term. Even anticipated increase at 48%, still below 50%. So it looks very healthy. We can see how they have room to really grow that dividend at a rapid rate. AFFO will increasing as well over the longer term, expected to continue with that trend. As we can see, 9% increases over the last 4 years, expected to be thereabouts again over the next 12 months. And we can see their sales growth has been a little bit inconsistent, but we do notice over the last year, strong double-digit increase, 13% on a trailing 12-month basis. Total sales then we can see pretty much tripled their top line over the last 10 years. And whilst they have diluted your position, you could argue on a little bit of a slower end than the others we have looked at today. ROIC, again, this is the wrong trend. We ideally want to see it move up. So 3% in 2023, as we've mentioned before, is towards the lower end of our ideal target at 3 to 5%. Margins also very inconsistent, definitely one just to keep an eye on. Hopefully they can pick up from the lows that we did see in 2022 of 9%. And in terms of net debt to EBITDA, one of the better ones we have covered today, well below 5.5, 3.83, anticipated to go lower into 2024 at 3.49, so it does tick quite a lot of boxes. Importantly, what does the valuation say? That is one that we are always keen to see, and today's episode, the intrinsic value arrives at $949. So 10% margin of safety, a buy up to 854, 15% pretty much around the current trading price, so around $807, does give you that 15% MOS level for this REIT. In terms of Wall Street and their expectation, well, as we can see, $915, their upside is 14% for this company. So again, it could be one that you are interested in, although it does depend on what criteria you have. So let me know if there are any that maybe these companies haven't ticked off. But overall, they are looking good, as we can see, 15% MOS and 14% upside. Now, there may be a lot of people that don't like to invest in individual REITs, and one of the more common essential ETFs that you can look to invest in is a Vanguard Real Estate ETF, ticker symbol VNQ. Now, this is one that does have an expense ratio of 0.13%, and this is one that you could consider for those that want to take on less risk and buy a bigger piece of the essential real estate pie. We'll take a look at their composition now, but one of the reasons that people don't like to do this, as you can see, over the last 5 years, their performance has been around 5% year on year, which isn't as good as maybe when you take a look at the S&P 500, around 10%. But again, it does come down to the individual investor, whether or not they want to invest in an ETF, or they like to pick those stocks that they do believe are undervalued and at a great price. For example, if you were to invest in the VNQ, as we can see here, Their largest position, Prologis, which we did cover as the number one stock today, it makes up around 6.47%. Again, Equinix, again one that we did cover, makes up 4.46%. So already their top three, two of them we have taken a look at today, which we do believe look to be very strong for the portfolio. We also note the ever popular Realty Income, 3.05%. But as always, let me know. Maybe you are someone that prefers to look at individual stocks. Maybe you're someone who likes to look at ETFs, or someone like me, you like to have a portfolio that does combine both. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button. As always, we'll see you on the next one, and for now, take care.